And those of you who are watching or listening in wherever in the world you happen to be. This is the start of the fall semester 2012 when it comes to Swedish monetary policy, and we're going to guide you through our views and explanations when it comes to the rate decision that we made yesterday. And I'm here, Stefan Ingves, and Marianne Nessén will also help you out when it comes to whatever technical details you are interested in. So yesterday, the executive board decided to cut the repo rate by 25 basis points. And all things considered, that was basically because inflation is on the low side. And this would add a bit to aggregate demand, and we would get to our inflation 2% target a little bit quicker compared to if this were not to happen. At the same time, we also pushed the interest rate path a bit to the left, so it will take longer than otherwise before we start hiking the rate again. And this is so in terms of the path, and given where we are, given that rates are historically low, then of course if you assume some sort of normality, then of course the rate would need to go up over time, so that we eventually would get to some kind of steady state. But having said that, on the other hand, for 5 years now we've been struggling with this, and many other countries have actually struggled much more than we have. Everything that we do is, of course, happening against the backdrop of what's going on around us, particularly what's going on in Europe. Can be described, discussed, argued about in many different ways. So this is kind of a short version of doing that. We have this duality in Europe, here exemplified by Sweden and Germany, where the long rates are very tightly together, and also in a longer time perspective very low. While on the other hand, you have then here Spain and Italy, where the rates have been for quite some time going up, and that holds also for a number of other countries. And this, of course, is just sending the signal that somehow this whole system is not balanced. And there is a need for a rebalancing one way or the other, and that's going to take time, and it won't happen. It just won't happen overnight. And one way of reflecting on that is to look at it from a structural perspective. There are many structural issues under the surface here, but if you do it in terms of unit labor cost, these graphs are very clear, particularly within a currency union. If you have these differences in unit labor cost, then you have some adjustments to make, and that doesn't happen overnight. And in the meantime, when you do those adjustments, aggregate demand in those countries where ULC has gone up a lot is going to fall one way or the other. You end up with a budget deficit, and that has to be managed as well in one form or the other. And how that is supposed to happen, what the adjustment process is supposed to be. That's really what this issue is all about. That's not, of course, so much a Swedish issue for the day, because we are in a quite good shape compared to many others. But what's going on in Europe, what's going on around us, also affects us. So in that sense, this also matters to us. The baseline scenario that we stick to, and there's nothing new about that, is that eventually these problems will be solved, but it will take time. And if that holds, then our projections are very reasonable based on that. If it doesn't hold going forward because there are surprises around the corner, well, then we might also have to reconsider. But all in all, what this leads to is weak developments in the euro area. Here you can see the red dotted line, growth between 0 and 2%, and it's going to take a while actually to get up towards 2%. While on the other hand, looking at the U.S., we're getting to numbers that we have seen in the past, so we can kind of recognize that things in the U.S. are moving in a reasonable direction. That is not saying that there are no issues to deal with in the U.S. economy at all. But looking looking at it from a very simple sort of growth perspective, which is what is important to us, this is what we see. And also looking at the global growth, given that a number of BRIC countries still continue to grow and smaller countries as well, then global growth around 4%, something like that, is not unreasonable. And given that our exports are more distributed across the globe than in the past, that is something which of course also benefits us. And the Swedish economy is still relatively strong. Looking at the numbers here, actually surprisingly strong in the first half of this year. And as you can see here, because these are quarterly numbers, you can also see here that according to the July projection, and where we are now, the second quarter was much higher than what we expected. And that of course also means that in terms of the numbers for the full 2012, the level of GDP will be higher than what we expected. And then of course that leaves us with the issue then, what's this thing going to look like going forward when we're talking about 2013 and 2014. And as you can see here, our projection is very sort of similar to what we had in July, so there are no major surprises there. And that of course then mainly comes from the fact that the rest of the world is, as far as we can judge, be a bit on the slow side, and that also affects us. One way of reflecting on this is to look at the economic tendency indicator, and that also speaks in favor of dampened growth in the coming period. Well, at the same time, and I do think that this is important, is that we're not talking about a rerun of 08 and 09. We're talking about positive growth numbers, a bit on the slow side, and then things normalize gradually. So in that sense, in terms of this type of graph, it's a scenario where we're going to be not that far from the mean 100. And the krona is stronger. The krona has actually ended up stronger than we expected, in the sense that the appreciation came during the summer and came much quicker than we expected. But in terms of the level is still roughly what we expected in July. So in that sense, over the whole span of this period, it's not a major change in terms of our projections. And of course, the effect that you get in the Swedish economy in terms of what it does to the inflation rate and all of that comes sooner rather than later, given these changes, and that also matters when it comes to present monetary policy. The labor market, in terms of our projection for September here, unemployment will go up slightly in the near future, and then will continue down once things are more and more restored to normal around us. And that means that, as far as we can judge, then unemployment will gradually fall. But in terms of projections, there are no major changes or surprises there. It's sort of fairly close, actually, to the way we looked at it in July. All in all, then, adding things up, this produces lower inflationary pressure in the Swedish economy. First of all, as far as we can judge, despite our good first half this year, and depending on what's going on in the rest of the world, we expect weak growth in the coming period. At the same time, we have had good productivity growth in the past, and that means that despite the fact that growth ended up being much higher than we expected, if you pair that with the productivity increase, that doesn't really then produce much of a cost pressure in the economy. And that means that we don't think that the growth burst that we have observed is inflationary. And then the stronger krona I already talked about, and that also, of course, pushes price pressures in the domestic economy lower compared to if that had not happened. And then turning all of this into monetary policy, this is then what we get. We lower the rate by 25 basis points, And then we have pushed the interest rate path a bit towards the right, which is, if we are right here in our views, means that the repo rate would start going up sometime towards the end of next year. But as always, and this in terms of inflation then would take us to an inflation rate that approaches 2% in terms of CPIF, and given that towards the end of the period you end up also with the repo rate hikes, then that, given the way our CPI is constructed, would push the CPI above 2%. But this is a forecast. As always, it's not a promise. On the downside here, if things were to take a very different turn in Europe compared to what we expect, and things were to get worse, then that's likely to affect us as well. And then that would also affect Swedish monetary policy. While on the other hand, on the upside, if the growth numbers that we have observed over the past 6 months, if they were to stay at that level, then again we would be in a very different situation when it comes to aggregate demand in the Swedish economy, and that would then more likely push up the repo rate sooner rather than later. But this time, summarizing the whole thing, all things considered, we concluded that the most suitable thing to do was to cut the rate by 25 basis points. This has been kind of in the balance, because some of these signs we could already see in July, but then we weren't quite there yet. And this is basically to counteract the low inflation that we expect ahead. So, questions, reflections on this?
The conference has been unmuted.
If you want some more time to think about questions, I could show you a couple of graphs just to show what we thought were the main difficulties during this last forecasting round. So I think I'll talk a little while, and you can think more about your questions. There were two main issues during this when we produced the projections. One was the very, very strong Q2 numbers, and the other one was the strong krona. What to do, how to sort of analyze that, and what the consequences were for the forecast. Now, starting with the first issue, the strong Q2 number. Here, the blue line you recognize very well, and the surprisingly high number that we received a few weeks ago. As Stefan mentioned earlier, when we did our analysis, we came to the conclusion that this was a temporary burst in growth, and we see a reversal. So in the third quarter, we expect a negative growth in GDP, mainly because, I mean, one of the reasons why it was so strong in Q2 was exports, and given the way things are turning out in the euro area, we expect exports to drop in the second half, or to be weaker in the second half of this year, and that will sort of be a drag on growth. We also have forward-looking indicators which support this assumption, or this projection. Now, together with the strong growth, we got another number, namely the hours worked, which were a bit on the low side. And as you know, together this means that labor productivity is unexpectedly high. I'm going to show you now three graphs which show how our view have changed a little bit now in this last forecasting round. So here is labor productivity, and the forecast of labor productivity for the four reports that we have produced this year. So it's February, April, July, and September. I think it's a little bit messy this graph, but it gets clearer as I go along. In this particular figure, I think we can abstract from the gray line. There is a data revision issue there, which makes interpretation a bit difficult. But if you look at the July forecast, which is the blue line, and April, what we saw was a fairly muted development in labor productivity during 2012. This picture has changed now. So we see labor productivity picking up now and staying at a slightly higher level. In order to get to where I'm aiming to go, namely unit labor costs, we first need to look at labor costs per hour. And the message from this picture here is that there the forecast has not changed very much. We don't have new information that has led to a new conclusion. So the bottom line then is what's happened to unit labor costs? Again, February, April, and July, we had the view that unit labor costs would be temporarily high, so to speak, during 2012, before going down again to its historical average, 2%. And that picture has changed. So now instead, as you can see in our tables, we've revised the unit labor costs for 2012 somewhat and brought it down to about 2% also for 2012. So this is one reason why we say that there are lower inflationary pressures, and this is one of the factors which led to the conclusion that the repo rate needed to be lowered and monetary policy more expansive. Yes?
Do you say that's the most important factor, more important than the krona appreciation?
We haven't made any types of calculations. This is a big picture of the. This is a part of the picture, but this is important. The krona appreciation is another one, but it's difficult to say which part is the most important.
Yeah. Another question in that respect.
Me too.
Do you think the uptick in productivity was a one-time occasion, or is it a more fundamentally underlying positive trend you just now see?
So let me go back to that graph. Well, as you can see from our graph, it's a bit wobbly, the forecast, but it is sort of going towards 2%. I have some colleagues here from the Monetary Policy Department, and if they want to add any details to Knut's question, you're very welcome to add to my answers. But I mean, here you can see the forecast in black and white, or rather in red. And it's in the long term, it's not a fundamentally different assumption, but there is important differences in the short-term dynamics, which would have led to too low inflation next year, if the policy rate hadn't been lowered.
But I mean, looking at the gyrations here over time, if you look at what actually has happened, well, then there's been huge swings. So these things are just difficult to do.
Mm-hmm. About we had very little information about Q2 with these numbers. Are you nervous about that this is going to change in a week? That we all of a sudden don't have that high productivity that we thought?
No, because this is the nature of the business. You know what you know, and if the numbers change, then the numbers change.
Yeah.
But I mean, you have less information than normal when you have a GDP figure, since it came earlier than usual. And this could be revised quite a bit, and it's actually a big part of your decision in cutting rates today. So that's why I just wondered what your thought was about that.
I can add that we had very strong growth in GDP, and you can think about that. Is that a higher resource utilization or what? Or will inflation pressure actually be higher because of that? And our conclusion is no, it's not, because it was driven by productivity, and we expect growth to be very slow in the second half of the year. So the combination of these two factors makes us think that the high growth in GDP is not a factor that drives inflation up. And even if GDP growth will be revised down, well, then maybe productivity growth will be revised down as well. But then you have two factors, and they are taking out from each other. So.
I mean, in terms of robustness, if the numbers the real numbers were to be lower, it wouldn't change the conclusion.
Okay.
Two issues. One is we're looking at the historical episodes of debt deleveraging. Those episodes tend to be fairly prolonged and erratic and painful. And I think this time around, debt load is very high in very many countries. And what is your view about the risks of a more prolonged period of slow and sluggish global growth, also kicking into the Swedish growth rate? Yeah.
Two reflections on that. One is, of course, within the time frame that we're talking about this, how one looks at it. And our baseline scenario is to say it's going to take quite a while to deal with various structural issues in Europe, including a debt overhang. So in that sense, it's a prolonged process already. Another one reflection is that if you have a serious problem in the banking sector, normally you dig yourself out of that hole in 5 years at the most. Now in various parts of Europe, this has been going on for 5 years already, and we continue to be sort of at it. That's very unusual. And that just sends the signal that these things are not easy to do, because with that type of a measuring rod, we're kind of behind schedule. That's one way of describing it. But at the same time, it of course raises the issue that if you look at various projections, how we looked at the world, let's say from 2000 to 2008 or 2007, a period we came to call the Great Moderation, and then we ended up with something which wasn't that moderate at all. And one needs, of course, to be mindful of the fact then that we have had these very large swings in economic activity in various parts of the world for the past 5 years, and it's not over yet. And that means that in that environment, at some stage we need to ask ourselves, does that imply that there exists a new type of equilibrium in the future? And what kind of confluence of numbers are we then actually talking about compared to what we feed into the models as of today? Because we have to assume something when it comes to a normal repo rate, normal growth rates, and so on and so forth. And I just don't have an answer to that as of now, but it's something really, really worth thinking about.
May I follow up on that? If we are in for a more prolonged period, then we would, I think that's quite likely, we would perhaps expect negative real interest rates for another 3 to 4 to 5 years, and that has implications, of course, for your rate cut. Another
hard to tell. On the other hand, we know that if you end up with long periods of negative real rates, usually not so good, because then strange things tend to happen.
Another one is, I mentioned this issue before. I think your view about the transmission from growth to the labor market is, I mean, you have a drop in the unemployment rate already during 2013, as I can see it, while you only have GDP growth, still below 2%. That's a break compared with the historical pattern. And I don't think that GDP is perhaps the most reliable indicator of monetary policy direction, but rather resource utilization. In that sense, unemployment is a better gauge than GDP level.
Mm-hmm. First, then, the connection between GDP growth and unemployment. I mean, our unemployment forecast is very much based on the historical covariation between GDP in relation to its trend and unemployment. So there's nothing unusual, I think, about the way we've constructed this unemployment forecast. And it goes up a little bit in the short term, it's going to culminate during the first half of 2013 and then drop as growth picks up in Sweden. Your second question was on
in my view, I don't think the level of GDP is the most important indicator of for monetary policy is rather resource utilization. In that sense, I think situation in the labor market is a more reliable gauge than the level of GDP. And I think that the unemployment will probably trend upwards a little bit more. Then the implication for me would be that there are more rate cuts in the pipeline.
We don't have a single measure of resource utilization, as I'm sure you know. So we look at a broad spectrum of various measures because we think to be robust, we need to look across various indicators. And as for the implications for monetary policy, well, that's up to the board, and it's uncertain what's going to happen in the future.
Just risk-wise, looking at the how contingent on what the solution in the European area is the effect of these analysis. I mean, I guess you've made a prognosis for a stable solution, or in the end, but you know it can be a binary event, and I guess that would kind of change these numbers quite a bit.
Yeah, but that's just the nature of the business, because binary things are hard to deal with. And if there is a binary event which is large enough, then we'll have to redo the whole thing. I mean, that's how this thing works.
Yeah, but I mean, this must be a quite unusual situation where you have one of the largest trading partners for the area being in a situation where...
Let's hope that it's an unusual situation.
You don't have that much history to go by.
No, but we still have to decide. So that's just the nature of these types of decisions, and it's sort of another way of referring to what I just alluded to. That 2000 to 2007 things are kind of normal in the sense that in terms of doing projections, it's quite clear what the projections will be like. You get fairly close actually to what happens. But if you look at projections over the past, let's say, 5 years, take the past 6 months as a good example. It's just harder to do, and then we have to live with that, and that's of course.
Is that a reason to be precautious, or just wait and see?
Depends on as always what goes on in the rest of the world and around us, but. Given that the Swedish economy is in pretty good shape compared to many other countries, in my own view, it's very hard to find arguments for engineering wild gyrations domestically. There's going to be enough from the outside.
Could you elaborate on what you expect in the Eurozone? In your main scenario, what's your expectation? You just say that it's going to...
No, I mean, we have the growth numbers in here, but then it's very, very hard to say that particular growth number implies that the ECB is going to decide this, that, or the other, or that the Greek IMF program is going to end up in this way or that way within whatever the name of the quarter. That's just way too hard to do. I would like to be able to do it, but it's just too difficult to do that. But on a more positive note, though, is what one should be mindful of the fact that if you don't look at the EMU as a whole, if you look at individual countries in Europe, I mean, the Baltic countries are more or less out of their very, very serious difficulties that they had, and there's been a turnaround there, particularly if you look at, let's say, Estonia. In the case of Ireland, they've been at it longer than many others, and that means that they are getting closer to a turnaround. Portugal is doing roughly what they've been asked to do by the IMF, and that means also that of course on their side increases the likelihood. But then on the other hand, you have some very large countries that have more homework to do, and that makes it very hard to judge then in terms of the end result for Europe as a whole.
But in your experience fixing banks, has the solution or the ways that they've dealt with the banking problem in Europe been the correct way to do it?
Not so far, because banks have not really been fixed, except with a few exceptions. Take Ireland. And the longer you wait, the lower growth you're going to end up with, and the more the cost you're going to have to carry in one way or the other. Now, of course, then one extra fly in the ointment here is the fact that if you at the same time have a debt problem, then you need to find a way of actually dealing with the banks. But doing nothing doesn't really change much. So in the end, you're actually going to have to deal with it one way or the other. And ultimately, at the end of the day, it's quite likely, in my view, that the banking sector in Europe is actually going to have to shrink. That will be the end result, because if you go through a process of deleveraging, then you have to do something about the fixed cost that you are carrying with you from the past, and that essentially means fewer branch offices and fewer banks in one form or the other. But to go through that process itself is, of course, very, very painful, and sometimes countries try to avoid that for as long as possible.
If you've seen the measures taken today by Mr. Draghi, do you think we took? You said that this would be the backstop, but I can't see there is a backstop for the banks in this. So are we anywhere closer to banks?
Well, it's hard for me to judge what really the ECB has said today, because I've been focusing on our own stuff. But in the end, it's one element, and there are many different things that you need to do. We tend to think about these things in terms of if a certain measure is being decided on a particular day, then the whole problem would go away. But in the real world, you have to do many different things. And ultimately, if you have a fiscal problem, you're going to have to fix your fiscal problem. If you have a problem with the banks, you're going to have to fix the problem with the banks. And the issue there is that there is never one single measure that takes care of that. And particularly when you start dealing with fiscal issues and when you start dealing with the banking problems, then you have to do the plumbing, if I call it that, at the micro level. And that takes time, it's complicated, and you have to have lots and lots of people who are actually willing to deliver these things at the micro level, and that doesn't happen overnight, and it's not dependent on individual decisions made by the ECB. I'm not saying that what the ECB has decided is a bad thing, but I'm just saying that there are many aspects and many things that you have to do. And ideally, you need to do them more or less in parallel, which is sometimes with many different countries and many different views of the world, very hard to engineer.
There's a proposition from the Commission that the bank supervision should be done by the ECB in the future. Is that something that would make you feel safe?
It would be better for Europe if we had a common definition in Europe of how to define non-performing loans. And it would be good for Europe if we had that common definition and if it were checked by independent people to ensure that it is actually carried out.
So that would be something the Riksbank would support?
I don't know what's going to be in those papers, so we will see. I'm talking about this as a general principle, because if uncertainty is an issue, if there is a feeling that you just cannot judge what Bank X looks like on the inside, then you need to find a standardized way of reducing uncertainty in such a way that investors say that now I have understood whether this is a lemon or a bank which is okay. And as long as that type of system does not exist, then we still have Europe is going to continuously have a bank problem. And that you can manage from day to day by providing enough liquidity. But that doesn't really change anything on the ground, since it keeps the whole thing going for another day, but it doesn't deal with the structural issue that eventually you're going to have to restructure the banking sector.
So it must be very hard to have a forecast on Europe.
Yeah, but we still have to do our forecasts. And it says that it's going to be on the slow side in Europe, and I think that's a pretty safe bet. So in that sense, it's not so strange. Yes?
So at today's press conference, you said that the household indebtedness was no longer an issue after being so for 2 years. So will it stay so, what can bring it back?
No, I said, to be more precise, that it wasn't an issue for this particular decision this time. But given the debt-to-income level in the household sector, it's an issue which is likely to stay with us for a long time. The issue is more how to deal with it and who should do it and what falls on monetary policy and what is to fall on other types of policy making.
In regards to that, credit growth to companies, is that something you're starting to get worried about? It's coming down quite quickly. Or what's your view on that?
No, not that it presently has been an issue in the sense that we don't get signals that companies can't borrow. So that seems to be fine for now.
Yeah.
And I mean, one of the odd characteristics of this whole 5-year period that we're talking about, and this it's not only for an issue in our case, is that companies have actually been quite liquid in many countries. So the problems have really been in other sectors, and in some countries, in some instances, they've actually been so liquid so that they haven't really needed to borrow anything at all. They set up almost like their own systems almost to surpass the banking sector when there has been all sorts of bank problems.
Even before today's rate cut, we have seen recently during the summer that the households' expectation, particularly of their own economy, has improved actually, and is above historical average. Aren't you afraid that household indebtedness can rise again, and that very low and lower mortgage rates can also?
Yes, that certainly is an issue, and these are difficult trade-offs. If that were to happen, then we need to get the higher capital charges, a liquidity coverage ratio down to euros and dollars, put in place as quickly as possible. We need to get back to the whole debate about amortizations and many other issues of that type, because it wouldn't be good to have a debt-to-income ratio just that goes up and up and up, because it can't go up indefinitely. That will cause us major problems, but beyond the horizon that we're talking about now. So the issue is more how would one then, in that type of an environment, find a reasonable mix between monetary policy and other types of measures.
Are you expecting any schedule? Do you have any time schedule to other kind of measures?
Yeah, well, the LCR we hope to have in place 1st of January next year. That's one step, and then the increased capital charges have been announced, so work is going on there. That's more an issue for the finance ministry. But then I do think that we need to get back to this issue about amortizing loans, and it would be kind of nice to see if it could happen in the private sector, by the private sector itself, because then the public sector wouldn't have to do it for you.
I guess the flip side of this is how will the transmission mechanism work at these levels? Will it actually become cheaper to borrow money, or will it just be more profits for the banks?
Yeah, I mean, there are no easy answers to these things. We just have to learn to live with it, because we do know that high debt levels are dangerous, and it's not good to end up there. And then we just have to think about the rules, and also kind of the combination between whatever rules you have in place and the general level of interest rates, because if there is no relationship at all between those two, then eventually over time you would end up with a quite distorted financial sector, and that wouldn't be good either.
But just to follow up on an aspect of your question, I mean, we do expect repo rate cuts or hikes to sort of be reflected in interest rates of households and firms. Not immediately, but there is a strong correlation between those two. So we do expect things to happen on that front.
But in relation to this, the transmission mechanism and also the credit growth for households, do you think that in this period of time that it's only demand that is sort of making credit growth evolve? I mean, don't you think that it's a supply side problem as well in that issue? I mean, do you think that banks still want to lend as much as they did?
Well, we'll see. If you look at it over, let's say, over the past 4 or 5 years, then it's very, very clear that the increase has in loans has been trending down substantially. I think that we had a peak at, let's say, I don't have the numbers in my head now, but let's say the peak was 2007 or something like that at 12%. And now we are down to 4.12 or something like that. So in that sense, for quite some time, actually, we have seen a process where things have been slowing down. And from our perspective, that's a good thing.
Yeah, I just mean that even though you cut rates and the transmission mechanism works, that doesn't have to mean that credit growth is going to go up again.
No, I mean, let's hope that's the way it works. That's, from our perspective, that's the ideal solution.
We have seen also a comment connected to that is we have seen during the summer the STIBOR fixing has coming down, and actually, despite that you have kept the repo rate unchanged in the last couple of meetings, mortgage rates has continued down during the summer. Has that been included in your forecast that the margin will?
Yeah, in the sense that we actually for quite some time have said, if you go a few years back, that in the early 2000s the margins were too low. They went up substantially. They're going to come down, but they're not going to come down to where they were, let's say, in 2006. Then it's of course very difficult to do margin projections, but the general direction is very clear.
We do make assumptions, in particular when we make our CPI forecast. We need to be quite explicit. So they're going to come down a little bit in the coming years.
You were talking about maybe where we should think about a new equilibrium going forward. Is this something you're working on? I mean, new potential levels, new neutral rates. Is this something you're thinking about?
We're going to have to work. I mean, I'm thinking about it. Otherwise, I wouldn't have mentioned mentioned the issue, and which is not maybe that surprising, because if we have lived in this very different world by now for 5 years, then many are going to ask themselves that question: is there a new normal, or are we going back to an old normal, whatever that means? And there's good reason to really reflect and think about that. But in terms of how you do it in the boiler room when it comes to the model engineering, that's for others to reflect on. No, it's absolutely not. Absolutely not, but it's certainly an issue which is there.
I mean, there are many difficult analytical and modeling questions out there. I mean, the whole financial crisis has taught us that there's a range of issues that we need to look at more carefully now. And we do look at them more carefully now, but we don't have the full model support that we have for the more traditional analysis. I think it's going to take a long time before we're sort of we're all the way home on that issue, on that front. But so lots of people are thinking about it, but we don't have a new model coming up in the short term.
I would like to go back to the labor market. I have been myself very positively surprised and astonished about the resilience on the labor market during this year, and we can see it still. The employment continued to go up, to rise year-on-year terms. And it's not from the manufacturing sector, it's more from the services sector. Have you done any new research or conclusions, or what are you thinking about this in the future? Have something changed in the Swedish labor market connected to that?
Actually, I think I'm going to ask Christina if you have an answer to that question.
Coming in much much higher than we expected, both for the first quarter and for the second quarter. So if you look at employment growth in connection to GDP, maybe it's not so surprising. We still have high productivity growth. So I think I don't see that is something new. But at the same time, we see that the service sector are growing more faster. That's the place where you find the growth in employment, and that's maybe something new. It's been a long trend, but I think it's we were surprised during the financial crisis that the service sector managed so well, as employment fell so much in the manufacturing industry. So maybe something new there. We have to wait and see.
Yeah.
Okay, any questions from those of you who are listening in on the phone? If not, then we have exhausted this topic for today. Thank you for good questions and thank you for coming.